Vážené dámy a pánové, vítám vás u tohoto webináře na téma Fidelity Global Dividend. Je to vlastně jeden z fondů z naší rozšířené nabídky, který se zaměřuje na tzv. Dividendové investování jako investiční strategii. Co bude vlastně agendou toho webináře? Povíme si o portfolio manažerovi Danielu Robertsovi, povíme si o investiční strategii toho fondu, povíme si něco o jeho výkonnosti a rizikovosti a o složení portfolia a jaké jsou příležitosti a rizika investování. Tím tématem nás vlastně provede zde přítomná Caroline Pierce, což je zástupkyně Fidelity International, která přímo úzce spolupracuje s portfolio manažerem, je součástí investičního týmu, který se zaměřuje právě na tady ten fond Fidelity Global Dividend. Tady ten webinář bude v angličtině s titulky, které můžete vidět dole. A já přímo předám slovo Caroline. Caroline, welcome. Can you tell us something about the Fidelity Global Dividend Fund?
Yes, absolutely. It's a pleasure to be here. Thank you for having me. So what are investors buying essentially when they invest in the Fidelity Global Dividend Fund? We've tried to distill that into one sentence and we've put it on the slide here. And that is an unconstrained portfolio delivering a dividend-based total return with an emphasis on capital preservation. Now, hopefully, three important features you can see stem from that. The first of which is about this unconstrained nature of what we're doing. And essentially what we mean there is that the portfolio manager is not bound by any capital market benchmarks. He doesn't start by thinking about, am I overweight or underweight financials within the index? He starts by looking across the universe. And for that, we're using the MSCI All Country World Index as our universe, so 2,500 stocks. And then trying to identify those stocks with A, the characteristics that he's looking for, and B, trying to access those companies on reasonable valuations. And he builds the portfolio from the bottom up, from a blank sheet of paper in that way.
So that is by doing some kind of a quantitative filter that then filters through the universe, and then the portfolio manager can maybe look at a less number of investments?
Yes, that's true. With a universe of that size, it's necessary to start with some form of screening tool, and especially because we're looking for very specific characteristics from these stocks. Stocks that pay a dividend, for example. So we can very quickly filter that universe to a more reasonable size and then seek out those stocks that we particularly like that are very attractively valued at any point in time. Two important points stem from that approach. One, there is conviction in each holding. So each stock or each investment stands on its own 2 feet and there's strong competition for capital within the portfolio. And secondly, and importantly, that performance and positioning can and will differ quite materially from the index as a result. And that's important for investors who are looking for an active manager. What they don't want to see is something that just replicates the index. So with a strategy like this of only about 50 stocks, built from the bottom up, it's going to look very different from that index. But that gives it the potential certainly to outperform on that basis. The second characteristic is this dividend-based total return. So obviously the dividend is integral to the total return. It's a dividend strategy at the end of the day, but it mustn't come at the expense of that total return. Anyone could probably deliver you, 5 percentage points of income, a yield of 5 percentage points. But if it comes at the expense of 10 percentage points of capital, then really what's the point? So what we're trying to do is find that balance between what is an attractive headline yield for investors today, but also, a quality earning stream that's underpinning that, which will deliver you some dividend growth in the future. And if we get that combination right, what you'll see is real growth in the distribution, so some form of inflation protection for investors as well.
So in terms of this fund, it's more about the quality of dividends instead of just going for the highest yielding dividend stocks.
Absolutely. Right? Yes, I think there are some funds that do take that approach, but we have such a strict valuation discipline. That means what we need to see is that high yield is not a sign of stress within that business, isn't a value trap per se, but that yield actually represents a quality business. And then the final part of that I mentioned was this emphasis on capital preservation. And I think that's a really important differentiator for this strategy. It is very risk averse. It does have all the risks that investing in equities entails, that has to be said. But in terms of equity strategies, it's definitely at the lower risk end of that. And our definition of risk is not a tracking error or a deviation from a benchmark. We try to think of risk in the same way that our unit holders do, and that is, what is the potential for me to permanently lose my capital? So we're thinking about that when we invest in individual stocks as well. And, that's very relevant if you think about the theory around compounding, which can be very positive if you reinvest your dividends and compound them over time. It becomes an important driver of total returns. But equally, if you start to compound your losses, you can get yourself in a hole that's very difficult to get out of. So that's why we pay very strict attention to trying to protect that capital. So that's essentially what we're trying to achieve. If now we discuss, very, very briefly how we go about that in practice, and that is by trying to build a margin of safety into the portfolio. So how do we manage that risk essentially? And we can do that in three ways. One is by having a very strict valuation discipline, as I mentioned earlier. So the portfolio manager believes that valuation is the single most important determinant of future returns. But at the same time, I wouldn't want you to go away thinking, he's a value investor that just looks at the highest dividend yields or the lowest PE stocks in the market. Instead, what he's doing is recognizing the long-term nature or duration of the asset he's investing in, which is equities. And if we do that, what it means is less focus on what a company just earned or just reported or what they're set to report in the next 3 to 6 months.
So it's more about the story, what the particular stock is all about analyzing it more than analyzing its past financials and so on?
Yes. So just not looking at things on a short-term basis. Thinking about this stock, the industry that it sits within, and what's the right, if we're going to value that stock, what time frame should we be doing that under? If we want to assess, is it under or over earning versus its history, we may need to go back 20, 30 years in order to do that. So looking at the last earnings report is not a very good guide.
Also because a lot of companies are really cyclical, right? And then their earnings deviate a lot.
Well, I mean, that is a trap for some investors. We typically, we won't be investing in sort of, short-term cyclicals because of the volatility that entails and the forecast risk that goes with that. And as I said, we're trying to have a strategy that's risk averse. So we want a relatively smooth journey for our investors. That's not to say we can't invest in cyclical areas of the market, but we have to be able to hold them over a full market cycle, I guess. So the second way that we can build what we call a margin of safety into the portfolio, certainly another building block of our approach, is by looking for stocks with very specific investment characteristics. And we've put a list of them here on the slide. They're things like simple, understandable business models, strong cash conversion, healthy balance sheets, transparent financial statements, and sensible capital allocation. So they're the sort of investment characteristics that we're looking for these companies and the managements of these companies. And then the final way the final building block, I guess, of our approach is around portfolio construction. Looking for the right balance of conviction and diversification from the portfolio. So that means for us a portfolio of about 50 stocks. Some managers may have 100 plus stocks. But Daniel Roberts, the portfolio manager, believes that, he has a much better sense of a 50 stock portfolio and keeping on top of those stocks than he would do if he had a much bigger portfolio of holdings. But, realistically, if you think about the number of days in the year, etc., you've got to stay on top of your existing holdings. You've also got to look for new investment ideas, etc. So in order to know your stocks inside out, as he does, he feels that 50 is the right number.
Sure.
But also, if you think about what's required to be diversified, it's a lot less than 50 stocks. So that feels about right in terms of the number of holdings. We invest only where we see opportunity. So that means, having a diversified portfolio, but not feeling the need to be in every sector and every geography of the market. So they're the building blocks of our approach. If we get that right in practice, investors should see three key outcomes. I mean, this is essentially what we're aiming to deliver investors. One, the significant cross-cycle outperformance. Now that comes from the unconstrained nature of the portfolio, as I said. The second outcome is real growth in that distribution. So finding the tension between that headline yield today, but the growth within that earnings or within that dividend over time. If we get that right, you'll see real growth, so ahead of inflation. And lastly, and very importantly, in terms of the risk, a lower drawdown than both the market and our competitors. And if we can manage that drawdown, when volatility picks up or the market turns down, if we can limit that drawdown, then you set yourself up for potentially, very healthy longer-term performance over time.
So it can be said that on average, you invest in less volatile companies, right? More stable, maybe even cyclically?
Yes. If you think about, an income stock or a dividend stock, these tend to be, and I mentioned some of the characteristics, defensive businesses with resilient earning streams that are relatively visible, high levels of cash generation, strong balance sheets, etc. So these characteristics make them less volatile over time.
Probably also larger companies, right?
Yes, there is a large cap bias to what we're doing here. Those type of quality companies, you do tend to find them in the large cap space. But equally, we want to ensure, we have a scalable product. So it makes sense to invest in the large cap area. So that's essentially the outcomes that we are aiming to achieve. We can measure our success, obviously, since the launch of the product against each of those outcomes. Performance over time, certainly longer-term performance has been very strong versus the peer group. The last 12 months have been more difficult, it has to be said, for the strategy. What we've seen is a lot of stylistic influences, rotation within the market away from those defensive companies into more cyclical areas of the market.
So you can say an investment mood of investors that were moving between different investment styles, right? Away from dividend investing. Do you think that it's a long-term trend?
No, I don't think so. I think what we're seeing is obviously we're at the beginning of an interest rate hike cycle, and that plays a part. If you think that investors are potentially anticipating stronger growth coming through, and therefore they're favouring more cyclical areas of the market that they think will benefit from that. In our view, where levels of corporate profitability are today, they still sit around their all-time highs. So the potential for those companies to grow their earnings from what is already a very high level, we think is limited. So we don't think this is a longer-term phenomenon. We think that we will remain in a relatively low growth, low interest rate environment. And one of the reasons for that is that there are a number of deflationary forces that exist within the system and in large part are accelerating. If you think about levels of debt, if you think about the impact of technology, they're just two of the factors that are deflationary in nature. So without, high levels of inflation coming through, we don't expect central banks to feel the need to raise interest rates too far, too fast. And so in that environment, this search for yield will go on.
So you can also say that when the dividend investing is underperforming, right, the companies are getting more attractive because they're getting lower in value, basically. So into the future, if in long term the dividend investment strategy outperforms the average, then you can say
I think
that this may be a good time to invest relatively versus...
Well, that's certainly our approach. So we have taken the opportunity where we've seen these rotations into more cyclical areas of the market to add, attractively valued quality defensive stocks to the portfolio or add to our existing holdings. So you're absolutely right. What you end up with during these periods is, a portfolio of quality names with a lot of valuation support because they're out of favor at the moment. But as long as you've got the right investment time horizon, we still believe it will be a very sensible strategy. So, that's, performance. Certainly we've, since the launch of the strategy, we're very happy that we've seen that real growth in the distribution per unit. And we'd like to think, we'll look back in a number of years' time and we'll see that. So our objective there on a cross-currency basis, to be clear, is mid-single-digit growth within that distribution. And then that final objective that we're aiming to achieve is that lower drawdown. And I think we can point to that, significantly, certainly in US dollar terms, significantly lower drawdown than the market and the peer group since the launch of the strategy. And on this slide as well, on the right-hand side, you can see how the portfolio has performed on a rolling 12-month basis in different market environments. So we're essentially showing it, how it's performed in strong markets where the return of the market has been greater than 10%. In those moderate markets where the return of the index has been between 0 and 10%. And I think importantly, which is what we've highlighted here, in falling markets, this strategy has not only protected investors' capital, but has generated a positive absolute return during periods where the market has generated a return of less than 0.
So that's basically the biggest difference between Fidelity Global Dividend Fund and competitors, right? Because when you look at the averages, they maybe invest in higher yielding equities, but then the dividend level is more stable in different years, and you invest in much lower yielding dividend strategies, still higher than the market, but the dividend grows over time, right?
Yes, well, I think there's a number of different ways that you can approach dividend investing, and that's evident from the peer group. So you have those that just invest in high yielding stocks. The concern there is that, that yield won't be sustainable and there's potential for dividend cuts. And we've seen that, certainly since the financial crisis in different sectors. Then there's those other strategies that are barbell in nature. So some high yielding stocks and some growth stocks. For us, we fear that introduces a level of volatility that some investors may not be comfortable with. So you're right, we would prefer what we think is an attractive headline yield today, but that potential for dividend growth to come through to increase that distribution in real terms year on year for investors. Yes. So they're the three outcomes that we're aiming to deliver and how we've been measured against those. If we just turn now to how the portfolio is positioned today, we have a slide here just showing you the portfolio on the basis of its sector allocation. And, if I were to look at that, the first thing I would say is, it looks relatively well diversified by sectors. So you've got 5 different sectors there, each contributing around about 15% of the overall allocation. This type of strategy tends to be have a bias towards higher return, higher quality businesses. You tend to find those within the consumer space, healthcare, industrials, and some technology names. Within the bond proxies, it looks fairly defensive. If you think about healthcare companies, consumer stocks, etc. But we are able to invest in some of the more cyclical areas of the market or cyclical stocks. But that tends to be within technology and within the industrial space, where we can find higher quality cyclicals that we're happy to own across a full market cycle.
So can you elaborate why do you think that utilities are more attractive instead of other, as you said, bond proxies?
Within the utility space, we have a particular bias towards regulated utilities. And regulated utilities have their returns linked to inflation. So that can provide you with that levels of growth within that distribution.
So they are more protected from competitors, right?
Yes, yes. That's correct. Whereas, you're quite right in terms of, the challenges from competitors or regulators, for example, then telecommunications, we're a little bit wary of, I guess.
Sure.
And real estate investment trusts, it's fair to say that they are looking more attractive, given the underperformance that we've seen and the fact that a number of them sit at quite a significant discount to their NAV. They are starting to show up on our screen, but we don't own any at the moment.
Sure.
What you'll notice here is two pie charts or donuts. The one on the left-hand side breaks down the portfolio's regional weights by domicile.
Which means where the equities are listed, right?
Yes, so where the company's headquarters are based, essentially. And, this is what you'll see on a fact sheet. But when we're in practice, when we're managing the portfolio, we prefer to look at where companies are generating their end revenues or their economic exposure. So we think that is a much better representation of the geographic diversification within the portfolio. And you can see some very big differences between the two. So, on the basis of direct exposure, we've only got 4% within emerging markets. Whereas, through the investment of companies that sit within developed markets but sell their wares into emerging markets, we actually have a 20% exposure. So quite a big difference there.
And that's because nowadays Europe and UK is relatively export-oriented, right? And
yes.
So they have their sales in basically different regions.
Yeah.
So you probably invest more in multinationals than you would say would be true for other funds.
Yes, that's correct. I mean, you've only got to look at, within Europe ex-UK, some of our biggest holdings are some of the professional publishers that are based in Europe, but actually generate 75-80% of their profits from the US. So, where a company is headquartered is not a good indication of that economic exposure or, where they're generating their revenues.
And of the diversification, right, that's embedded in the fund.
Exactly. So that's in terms of geographic positioning. And then we've just included some analysis here about the portfolio's distribution. Because obviously as a dividend strategy, you want to see, diversification within that income stream as well, so that you are not subject to, if you were subject to a dividend cut, what impact would that potentially have on your distribution over time? So the top left-hand chart shows you that here. So there's no reliance on any one sector for our income. It's relatively well diversified. And that, should we face a dividend cut, which is obviously something that we're trying to avoid at all costs, we wouldn't be jeopardizing the dividend growth or that growth in the distribution that we're aiming to achieve for investors. A couple of other points, the cumulative distribution of the yield there. We're simply saying that, each and every stock within the portfolio is contributing to the overall yield. It's not just concentrated in a handful of stocks, as it is within some of the market indices, like in Asia Pacific, some of the country indices in Europe, or indeed within the UK, where sort of 10 stocks account for 50% of the market's yield. So each stock contributing to the overall portfolio yield. And then finally, you can see the breakdown of the portfolio by yield. So again, good diversification there, a mix of stocks with sub-market yields, so less than 2.5%, those are the stocks that we would expect relatively significant dividend growth from. But equally, there's, between 10 and 15% of the portfolio invested in stocks that have a yield over 5%. So a healthy yield today and potentially very limited dividend growth. But, with a global portfolio, we can combine all these types of stocks together. So that's the portfolio distribution. A quick note just to say in terms of the dividend growth that the portfolio today is generating. If we look at the most recently reported dividend per share growth, we're looking at about 6% growth across the portfolio. So that's what we're showing there. And then we've included a slide just to show some of the changes in the stock positions over the last 12 months. So fairly evenly distributed between additions to the portfolio and disposals to the portfolio. I think you'll recognise some of the names there. That speaks to the high quality brand names that we do invest in. They're across sectors, they're across geographies. And they are a mix of, more defensive exposures plus some cyclical exposure where it makes sense.
So would you say that the portfolio manager disposes of a certain stock because it's overvalued or because maybe it belongs to a certain sector that is not going to be favored in the future or some other reason?
Yeah, no, disposals, everything's done on a stock-specific basis. So there's no sort of top-down macroeconomic or thematic influences on the portfolio. So it's all stock-specific. But if I think about, the last 12 months, certainly, a lot of the disposals have been driven by valuation. So companies that we may fundamentally like, but just where their valuation has been driven, too far, too fast, for example, and we can no longer justify that. So that strict valuation discipline that we have will, kick us out of those stocks. And if I look at this list, Scentre Group is a good example, McDonald's, similarly, Harris, PepsiCo, Tiger Brands. These are all stocks that, we like and we will continue to monitor over time, but their valuations just got away from them, we believe. Sure. And then finally, I've included an example of a stock, some of the more cyclical exposure, in fact, within the portfolio at the moment, and that's Deutsche Börse, which is the German exchange. This is a very high return, capital-light business. Operates as a monopoly. We like monopolies, because of the barriers to entry, the value that confers onto the business. But a couple of things here. There's some structural growth drivers that we think are driving Deutsche Börse insofar as the rise of passive investment requires the need for these indices, and that's the sort of intellectual property that Deutsche Börse owns. But more, I guess, in the short term, a company like Deutsche Börse is set to benefit from A, an increase in volatility within markets, but B, an increase in interest rates. And both of these things have been at, multi-year lows. So any increase from here is likely to be good news for Deutsche Börse.
Why do you in particular say that Deutsche Börse is a beneficiary of interest rate rises?
Yes. And in terms of, the valuation of Deutsche Börse, there was a proposed merger with the London Stock Exchange. There was some doubt about that because of the Brexit vote, etc. That provided an opportunity for us to invest in the stock at what we thought was a very attractive valuation. At the time, it was the second cheapest of 15 exchanges listed globally, but had a dividend yield of more than 3%. So for us, it was a very attractive opportunity. It's done very well for us, and it is now a top 10 position within the portfolio. And I've also included in the presentation a list of the portfolio's top 10 holdings currently. Really, the only things to draw out here is, this is a mix of companies, both by country and by sector, all with, healthy levels of dividend yield and levels of dividend growth to go along with that.
Yes, because it's basically a global mutual fund, right? So you get some added diversification from having different sectors and different regions.
Absolutely. I mean, that's one of the benefits of going global, is you get that diversification. It means you can invest in parts of the market that you might not otherwise look at.
And as an investor, you don't have to really do the analysis yourself, which type of a region is more attractive than other and so on. So you don't have to look just into a specific part of a market and then invest into it and be less well diversified than.
Well, yes, and you don't face the concentration risks that go with that. If you're just investing in one sector or in one geography, then you're faced with that subset, and you may be forced into stocks that you wouldn't otherwise own if you had a choice. So being global, yes, means that you can sort of branch out. And that's very good from a portfolio construction and a risk reward.
Pick only the most attractive ones, right?
Yes, that's exactly right. And in terms of the portfolio's characteristics, we've listed them here. I think the main thing to say about this is that they have been consistent over the life of the strategy. So the number of holdings between 50 and 60 over time, the active money or the active share. So that is essentially, what is the overlap with the index, okay? And having 90% active share means you only have a 10% overlap with the index. So that comes back to that unconstrained nature of what we do and how we build the portfolio from the bottom up. Very low turnover from the strategy, between 20 and 30%. So essentially we are looking to hold these companies for 3 to 4 years. And that comes back to that point about, when we're valuing companies, we're not just looking at what they just reported or what their set to report. We want to expand our time horizon and generate a total return over that 3 to 4 years, ideally. We have a focus on large cap stocks. You should expect the volatility of this strategy to be lower than that of the index. And we are investing in high quality companies, which means that the return on equity is higher than that of the broader index. So essentially, what we're looking for is the right balance of conviction and diversification from this type of strategy.
Sure. So what do you think would be the most important things to remember about this fund, about Fidelity Global Dividend Fund?
Yes, well, I think, if we revisit exactly what we're trying to achieve with this strategy, so the important things is, it's unconstrained by nature, so that gives it the potential to outperform over time. I think the fact that, we're looking for a dividend-based total return, so where dividend and dividend growth are key components of that total return, but don't come at any cost. I think that's important if we're looking to achieve that real distribution growth for our investors. But importantly, I think, and this is particularly important in the current environment, I think the risk-averse nature, the emphasis on risk and on a lower drawdown is, particularly important for investors. If we think about, we're 8.5 years into a bull market, I think that there are risks to that going forward. I talked about earlier, levels of corporate profitability and where they exist today, and the fact that the market is ever more reliant on earnings to come through to support the market from here, whereas I think that is limited. So there is potential for volatility within the market, and so I think a strategy that has, an emphasis or a focus on risk at the heart of it would serve investors very well.
So dividend investing is maybe more suitable in the current environment of relatively high valuations to protect the investors, at least for some part of the portfolio, right?
Yes, that's certainly our view, yes.
All right, thank you, Caroline.
Thank you.
Děkujeme divákům za pozornost, děkujeme i Caroline z Fidelity International. Všechny tady webináře si můžete prohlédnout současně i na našem YouTube kanálu, který se jmenuje ING Bank Česká republika, kde se můžete podívat jak na tento webinář, tak předchozí webináře. Můžete se současně i přihlásit k odběru našich webinářů. A děkujeme vám za pozornost. Thank you, Caroline, for being with us.
Thank you.
Goodbye.